Every time the stock market crashes, people act like it came out of nowhere. But that's never true. Not in the 17th century, not in the 19th, not in the 20th, and definitely not now. The truth is, crashes always leave clues, not just in the numbers, but in the behaviors, the politics, the optimism, and the denial that come right before the fall. 4 patterns, signals that always appear before a crash. The playbook never really changes. Only the headlines do. And now, billionaire investor Bill Ackman is warning that those same 4 patterns are flashing red once again. So in this video, I am going to look at the 4 financial disasters across 4 centuries that all followed the same dangerous playbook, and the exact warning signs Bill Ackman is seeing today that mirror those historical collapses. Trump's current policies are accelerating some of them. And if history is any guide, ignoring these signs could be one of the costliest mistakes an investor can make. Before we begin, as always, this content is for educational purposes only and is not financial advice. Investing involves risk, including loss of principal. Past performance does not guarantee future results. Always do your own research or consult a licensed financial advisor before making investment decisions. Let's begin with the first crash. 400 years ago, during one of the wildest monetary failures in European history. Most people think modern financial disasters began in the 20th century, but historians point to severe crises much earlier, including a continent-wide monetary breakdown more than 400 years ago that didn't start with stocks at all. It started with coins. The year was roughly 1618 to 1619. Europe was sliding into the 30 Years' War, a brutal conflict that would rage across the continent. Armies needed funding, and governments were desperate. Instead of raising taxes, many territorial rulers turned to a faster fix: debasement, melting silver coins, mixing in cheaper metal like copper, and restamping them at the same face value. The coins looked the same but contained less silver, and were worth far less. The practice spread quickly across the Holy Roman Empire. Contemporary sources and modern research call the episode Kipper und Whipper, tipper and seesaw, a reference to the tipping scales, whippen, used to sort heavier good coins from lighter bad ones. Buyers literally traveled the countryside seeking high silver coins to remint with base metal. The term reflects those sorting practices, and the scales that tipped, kippen. Here's where it gets wild and predatory. Debasing states didn't just harm themselves. Agents took bad coins into neighboring territories, spent or exchanged them for good money, and carried the good coins back home to debase again. Neighbors then retaliated by debasing their own coin to avoid being the sucker, producing a monetary arms race across borders. Trust cracked fast. People became unwilling to accept bad coins, authorities began receiving debased coins back in taxes, and prices climbed rapidly. In several cities, local price indices for staples rose multiple times over in just a few years. For example, Augsburg's rye price jumped from 7,187 pfennigs per bushel in 1618 to 6,516 by 1622, more than eightfold. By 1623 to 1624, authorities were forced to withdraw the debased coins, declare them non-legal tender, and restore the old standards, essentially admitting that monetary manipulation had wrecked confidence in commerce. This brings us to pattern number 1. Monetary games undermining confidence. When governments degrade money, whether by clipping coins in the 17th century or by policy that undermines credibility today, markets seize up because trust is the real foundation of exchange. Bill Ackman has been consistent on this point in recent years. Credibility against inflation and in the treasury market matters. He publicly urged the Fed to act decisively to kill inflation, warned that weak credibility can implode markets, and flagged structural forces that could keep inflation higher for longer. Fast forward to today, and the similarities are hard to miss. Trillions in post-pandemic stimulus, a surge in inflation, and political pressure around rates have all stressed confidence in money and policy. Ackman has also warned that sudden policy shifts, like sweeping tariffs, can erode credibility and shock the system, risking a broader downturn. Back in the 1600s, people paid dearly for believing money was just metal. Today, if we treat money as just numbers on a screen and forget that confidence gives those numbers value, we're playing a familiar and dangerous game. But history doesn't just repeat in coins and currency. It also repeats in innovation, in the shiny new technologies that promise to change everything. Because when society convinces itself that a breakthrough is too important to fail, money floods in faster than reason can catch up. By the mid-1860s, America was deep in what historians call its Industrial Revolution. Railroads were the internet of their time, reshaping lives, work, and commerce. Between 1868 and 1873, the nation added around 33,000 miles of track, making railroads the largest non-agricultural employer in the country. Railroad bonds became the hottest investment of the day. From wealthy industrialists to ordinary citizens, everyone poured into them. Why? Because westward expansion and booming rail traffic seemed unstoppable, and investors believed that growth would simply continue. But beneath the surface, leverage was piling up. Railroad companies borrowed heavily to build tracks. Banks and private investors extended credit ever more freely, confident the boom would pay for itself. Many lines weren't profitable. Some weren't even finished. Speculative money flooded the market. At the center of it all was J. Cook and Company, a powerhouse bank founded in 1861. Cook gained fame selling Union war bonds during the Civil War, then became the financial engine behind the Northern Pacific Railway. But when it became impossible to sell millions in Northern Pacific bonds in September 1873, Cook's bank declared bankruptcy later that month. His collapse triggered widespread panic. The New York Stock Exchange closed for 10 days, a record shutdown. Banks across the country failed, dozens of railroads went bankrupt, 55 by November, and more followed. Construction plummeted, from 7,500 miles of new track in 1872 to just 1,600 miles by 1875. Unemployment soared, as high as 14% nationally by 1876. The result wasn't a short panic, it spawned the Long Depression, a prolonged contraction spanning years. So what caused the collapse? It wasn't just overbuilding or bad management. It was the debt-fueled optimism, the second pattern, the assumption that because the economy had grown fast, it would always grow fast. Sound familiar? This is where Ackman's views come into sharp focus. Bill Ackman has long warned about debt bubbles masquerading as progress. He's spoken repeatedly about the dangers of financial engineering, when companies or sectors use borrowed money to create artificial growth that looks strong but is built on weak foundations. In the 1873 crash, railroads appeared unstoppable. In recent times, we've seen the same kind of overconfidence in speculative tech, crypto, and even high-yield corporate debt. Ackman has pointed out how cheap borrowing leads to excessive risk-taking, exactly what happened in the 19th century railroad boom. Just like in 1873, when investors stopped asking whether railroads made sense and started buying just because prices were going up, today's markets often reward hype over fundamentals. And remember this, the panic of 1873 didn't happen in a vacuum. It followed a long bull market fueled by loose credit and aggressive expansion, the exact environment we've seen in recent years. Ackman has consistently flagged these conditions: low interest rates, reckless lending, and investor euphoria disconnected from underlying value. The panic of 1873 is a perfect example of how too much belief in unlimited growth paired with too much borrowed money can derail an entire economy. And if history is any guide, it's exactly the kind of pattern Ackman is watching for right now. October 19th, 1987, globally known as Black Monday, the U.S. stock market experienced its worst single-day drop in history. The Dow Jones fell by 22% in just one trading session. To put that in perspective, that's like the market losing over $7 trillion in value today, in a single day. The strange thing is that there wasn't one obvious cause. The economy wasn't in a deep recession. Inflation wasn't running wild. Interest rates weren't spiking. Instead, the crash revealed something new and terrifying: the way financial innovation can backfire when everyone trusts it blindly. The innovation of the day was called portfolio insurance. On paper, it sounded brilliant. If the market started to fall, computer programs would automatically sell futures contracts to limit losses. It was supposed to be a seatbelt for investors, a way to guarantee safety in a downturn. But the real story lies beneath the numbers. At that time, the market was on a steep upward spiral. Prices had surged 44% in the months before, and euphoria masked growing instability. As investors piled in, few questioned the fragility under the hood. What broke the market? It wasn't a shock war or economic collapse. It was computerized trading and blind strategies. When millions of investors use the same seatbelt at the same time, it doesn't prevent the crash. It makes it worse. As stocks dipped, computers began selling. That selling triggered more selling. Liquidity vanished. Panic spread. Within hours, Wall Street was in free fall, and there was no off switch. Markets around the world crumbled. In Hong Kong, London, Tokyo, and beyond, nearly every major exchange felt the shock. This was structural fragility made visible, and Ackman has warned about exactly this kind of hidden risk in modern markets. The Federal Reserve's response proved how close the world came to broader collapse. They injected massive liquidity and reassured markets, showing that system stability depends on central institutions stepping into the void. The crash showed something deeper than just bad luck with computers. It showed pattern number 3, hidden fragility and leverage. On the surface, markets looked unstoppable. Stocks were soaring. Optimism was everywhere. But underneath, the entire system depended on leveraged bets and automated strategies that no one fully understood. When stress hit, that hidden fragility didn't just bend. It snapped. Fast forward to today, and the parallels are striking. Instead of portfolio insurance, we now have algorithmic trading, high-frequency strategies, and AI-driven market makers. The systems are faster, more complex, and more interconnected than anything in 1987. Ackman has criticized this kind of machine-driven leverage, warning that complexity and speed make markets more brittle, not safer. Layer on top of this fragile structure the uncertainty of policy shocks. In 2025, Ackman warned that Trump's escalating tariffs risked an economic nuclear winter, a direct echo of how sudden policy changes can collide with fragile markets and unleash a panic. What connects all these dots? Invisible fragility. Systems that look modern and efficient may be poised for sudden failure. Automation amplifies panic. Programmatic trading systems don't think, they react. Confidence is fragile. Just as in 1987, today markets believe in stability until they don't. Policy shock as trigger. Regulatory or geopolitical shifts may not cause crashes as much as unleash them. And that brings us to the most recent market hiccup. At the start of 2020, the U.S. economy looked unstoppable. The Dow Jones crossed 29,000 for the first time. Unemployment was near record lows. Politicians, including President Trump, were celebrating what they called the greatest economy in history. Analysts were forecasting more growth, and investors piled into riskier bets with little concern for danger ahead. Then came the shock. The world witnessed one of the fastest market crashes in history. It wasn't caused by a war or a financial bubble. It was caused by a virus. As COVID-19 spread globally, fear spread faster. Between February 19 and March 23, the S&P 500 collapsed by 34%, wiping out trillions in wealth in just over a month. On March 16th alone, the Dow plunged nearly 13% in a single session, the steepest one-day drop since Black Monday in 1987. Entire industries ground to a halt. Airlines parked their fleets, restaurants shut their doors, cities went silent. What spooked markets wasn't just falling earnings. It was the sudden fear that entire business models might vanish. Who would fly? Who would shop? Could businesses even survive weeks, let alone months, without revenue? This was the moment Bill Ackman warned, hell is coming. America will end as we know it unless we shut it down now. He wasn't just talking about the stock market. He was talking about the virus. But his words crystallized the fear investors were already feeling. If leaders failed to act decisively, both lives and the economy could unravel. That day, markets fell over 1,300 points after his comments made headlines. Critics accused him of fear-mongering, but within days, the U.S. rolled out sweeping lockdowns, trillion-dollar stimulus packages, and a historic intervention by the Federal Reserve, slashing rates to zero and flooding the system with liquidity. Ackman's urgent call had, in many ways, been validated. The COVID crash was unique in its trigger, but not in its pattern. What it revealed was the fourth universal signal before every market collapse. Confidence collapse. Just weeks earlier, the market was euphoric. But confidence, once lost, evaporated faster than ever before. Selling became indiscriminate. It didn't matter whether a company was strong or weak, profitable or speculative. Everything was dumped in a wave of fear. Ackman has often said that confidence is the lifeblood of the system. The COVID crash proved it. Markets don't only fall because of bad numbers. They fall when the assumption of continuity, the belief that tomorrow will look like today, disappears. And here's the warning for investors today. In 2020, the spark was a pandemic. But the next time, it could be something else. A policy misstep, a geopolitical standoff, or a sudden debt crisis. The trigger may change, but the fragility of confidence remains the same. And once it breaks, no amount of optimism can hold the market together. When you look back at 4 centuries of market collapses, it's tempting to think each was unique. Different causes, different governments, different financial instruments. But Bill Ackman would argue the opposite. He says markets may dress up in new clothes, but underneath, they repeat the same old behaviors. Let's line them up. In the 1600s, the Kipper und Whipper crisis showed what happens when money itself is debased. Kings shaved coins, printing presses ran wild, and the public lost faith in the very foundation of trade. Ackman has said many times that the modern version of this is too much debt and too much printing. Once people believe the dollar is no longer stable, the system itself starts to wobble. In the 1800s, the Panic of 1873 showed the danger of hidden leverage. Railroads were real, the future was bright, but it was financed by layers of debt. The moment confidence cracked, the entire structure collapsed. Ackman compares this to today's private credit boom and the off-balance sheet lending that regulators barely see. It looks safe in the boom. It looks toxic in the bust. Fast forward to the 1980s. Black Monday showed the danger of innovation without understanding. Portfolio insurance was supposed to prevent risk. Instead, it multiplied it. The same thing is happening today with passive ETFs, algorithmic trading, and AI-driven strategies. These tools work beautifully until everyone tries to exit at once. And then, in 2020, the COVID crash reminded us of the 4th universal pattern: sudden sentiment collapse. Ackman himself was the poster child. In March, he went on national television, warning hell is coming, while at the same time placing massive hedges that made him billions when the market plunged. He wasn't betting on a virus, he was betting on the fragility of confidence. Now, put those 4 patterns together and compare them with today's headlines. Trump has pushed record deficits and promised new rounds of tax cuts, supercharging the first pattern. Deregulation under his administration has emboldened banks and private lenders to take on risks that mimic the second pattern. His rhetoric of endless growth feeds the third pattern: innovation and speculation without brakes. And his unpredictable policymaking, sudden tariffs, threats against the Fed, shifting alliances, adds gasoline to the 4th pattern. That's the synthesis. The patterns are alive today, magnified by political choices, global debt loads, and financial innovation running faster than oversight. And if you think the rules of markets have changed, you haven't been paying attention. Want to know what Warren Buffett has been buying and selling in today's market? Click the video on your screen to find out.